Good morning, traders. It's Monday morning, 10:36 here in the UK. Welcome to Money Mondays. My name's Mark from Trade and Train. We have a plethora of news this week. I mean, just scrolling through, if you have a look here, obviously Monday and Tuesday is slightly quiet. Nothing really to get the markets moving other than Brexit. We just seem to be inundated right now with it's on, it's off, it's on, it's off. So I think in simple terms, you have to be avoiding pound pairs unless you are the type of person that doesn't respect your trading rules. Right now it's a lottery. Buying because the market is now saying that there's a possibility that a deal could be on. It's just a gamble. So my opinion is stay away from that. Look at other markets, something that you can truly see. So other than that, let's take a look at the news. We've got flash services coming throughout the European session on Wednesday. Then we have OPEC meeting also on Wednesday. We've got US dollar CPI, inflation details, core retail and retail sales. It just continues. And then the big one, the FOMC at 7 p.m. GMT on Wednesday. Will the Fed continue to ease? If you look at it and what the markets are doing right now, we've got all-time highs on indexes. More easing is only obviously just going to potentially keep pushing those stock prices higher, gold lower, US dollar lower. But is that really solving the man in the high streets issue in the US? Not really, in my opinion. So, but what does my opinion matter? All we can do is trade what we see. So, will they disappoint and not ease, or not to the expected levels that the market's anticipating, or are they going to come in and unleash a bazooka and send stock prices soaring? All we can do is sit and wait and see what happens. Then we go through into late Wednesday. We've got GDP quarter on quarter from Kiwi, employment data from Australia on Thursday, followed by the SMB monetary policy rate, and then that follows by UK monetary policy. It's just relentless this week. So traders, this is a week to just Friday morning you've got monetary policy statement from the Bank of Japan. So inundated with news. There's going to be lots of volatility, but probably not until Wednesday. But what does that mean in terms of the charts, and what can we potentially look at? Well, things that we've been focusing on are the continued selling of the US dollar. Now, something we were looking at, and December is a true seasonal poor month for the US dollar, but there's usually a bit of a relief rally, and we've not seen it. Something we've been waiting for is a break above a previous swing high to give us that confirmation that we're going to see that little bit of a dollar rally leading into previous support, now resistance. So if we just scroll back out and just look at the 92 structure point, we can see if we go on daily, you don't get to see the pops through, you just get to see it as wicks. Now you can see here the market tested the level, tested and popped straight back up, tested again, and then we broke through. So what we're looking for here is potentially a little double bottom and then a push higher into towards 92. 92 would be a nice direct correlation if we look at the euro dollar in and around this 1.2 level. Now a lot is going to be dependent on what happens with the Fed. So you can see here we're guiding as to what could potentially happen. Now, I don't want to be trading long from these positions here. Always want to see a correction before looking to get long. So 1.2 would be a nice area to be looking to get long, providing we see some sort of rejection. If we don't, then obviously we'll be looking at the trend line for the next opportunity to get long, and that'll just look to run that up towards 122 and then maybe 125. Now, seasonal bias would mean that we would expect to see US dollar weakness throughout December, but that outflow of US dollars tends to come back in January, and we would expect then to see a stronger movement on US dollars. So we might see one more final impulse up on the euro before we start to see it roll over. Whether that's going to occur here at this longer term trend line, or whether we're going to see it up at around 125, only time will tell, and so will the charts. So stay disciplined. Intraday traders, if you are looking for shorts, well then you could look at a break of this rising trend line here and trade it back down, but that is obviously a lot riskier trade, and not something that we would advocate right now. Going over to sterling, we can see sterling is, well, prior to this morning, we were looking at a potential correction back up into here, and then obviously the weekend news came out and it shot price up. So next objective for sterling would be, if we stay disciplined, it's either going to be one of these two scenarios. So first scenario would be price breaks above 135, and then we can use this weekly resistance area to look for long opportunities and pushing price higher. Should we see Brexit deals fall and basically talks stop and the whole thing starts to unwind and unravel again, then we can start looking for the short opportunity. But that will only come when we see this rising trend line broken and committed. So where we currently sit right now, for me, trading pound is just, there's no direction. It is all on hearsay. You know, the main issues are still present: level playing field, fisheries, governance. They're all still there. So I don't really see it as a buying opportunity. I need to see more concrete evidence, and that will be when we get a confirmed direction, which will either be above 135 or break below this. Looking at dollar Swiss is, yes, last week we'd seen let's just drop down to the 4 hourly and you'd see it in a little bit more detail. So last week we got a descending wedge formation where we saw the market pierce, break out, and then today we've seen it pull back and now it's testing the lows. So ultimately, we've come back within the pattern. It's not a pattern I'd want to be trading right now, but like the dollar index, we've now got this little zone to be looking at and working with, which is around 8,900, even number. So we want to see a break above that before we look to get long. Getting short, I don't want to be trading short in these current levels, so I'd be looking to trade long as a correction or a corrective trade up in towards that 9,000, which would be correlation with 1.2 on euro or 92 on the dollar index. And then it's a matter of picking your favorite chart. Don't look at trading all of them. Find the one that you feel is best fit for your rules and trading strategy. Now if we take a look over at Kiwi, now Kiwi, this market has been just going ballistic like Aussie dollar. It is respecting a rising channel, but at the same point right now we do have commitment of traders extreme. We've got commercials actively selling this market, and they've increased their short positions significantly this last week. So looking to see how this market is going to continue to play out. Our preference will be looking for a correction and then looking to trade it long on a move back towards 68. So around this zone here, we've seen price break through, where we've got a nice rising channel through here. I would look to see price break back down, pull back in towards the 68, 67.50, and then looking for those long opportunities, providing we still continue to see risk appetite in the market. We are due a correction. I don't like buying at these elevated levels, so any type of correction I'll be then looking for some opportunity to get long. Gold is feeling the pinch today. This is probably on talk of or expectations from the Fed or stimulus talks. This is obviously going to have a detrimental effect on gold, but we can see that around this 1820, 1815, there's a significant level of demand in here where we can see that price does rally, but the last couple of attempts have been a lot weaker than previous. So I wouldn't be surprised if we see gold push down in towards the 1770s again, and this would lead for a lovely long opportunity. Now the one thing we have to be careful with gold is if we do see any sort of stock market correction like we did back in March at the beginning of the pandemic. I'm not saying that's going to happen right now, but if we look at certain indicators like smart money, the smart money is at a massive divergence. It's at a 2-year low right now, incomparable with indexes at all-time highs. Usually a leading indicator that we could be seeing a correction coming in the stock market, which is what happened back in March pre-pandemic. So right now, if that is the case, any sort of correction in the stock market, 10, 20%, 5%, whatever it may be, will probably pull gold down initially with it like it did back in March, and then that would be a catalyst then for people to transfer funds back into safe haven assets, and we could start to see gold continue its push north. It is a strong seasonal period for gold throughout December, January and February, sort of mid to late, and depending how strong that push can be, can go until March. So looking for long opportunities on gold, but preference would be around at least 1800 or 1770 area to get long. So sitting tight, waiting for those. One of my favorite charts this week is Swiss yen. You can see options here for a swing style entry. Some of our members, we do have another entry right now, which is literally just not far from triggering, which is, I'm just going to pull this down so you can see. It's a sell stop under the previous 4-hour candle, so this is literally just about to trigger. It's about maybe 10 pips from triggering, so this is a trade that we are actively looking to go into right now. If you don't have any orders on this, let's just have a run why we're looking at this chart right now. So predominantly, if we go over, you can see major weekly resistance. I'm just going to zoom right out so you can see it. We've got major weekly resistance coming in through from the 118.50s, and you can see the average movement has been around 500 pips in the previous 3 attempts. I mean, some of them have gone a lot further, but you can see at least 500 pips is the average sort of movement from there. And then if we look at how the market has gone into weekly resistance, we went in with an impulsive move right up into the big number. We tested 117.50s, popped through it, and then we had that bearish engulfing candle last week on Friday. So any sort of sell stop below last week's candle with a stop loss above the high, you know, that's going to give you a return, but obviously it's a big stop, lots of pips at risk, therefore reduces your possible reward. So how can we look at maximizing that return? So if we just drop down to the 4-hour, what we see is the market has given us a nice rising channel where we popped through it, so false break, then sellers have entered the market, we've broken through support, and then we've retested and it's come back into a nice little structure about 117. We've had that move above, and now sellers are potentially pushing this price back down. So we've already seen sellers come into the market. Now we've seen a correction which is running out of steam. We're seeing that transfer of buyers into sellers. This looks a really fantastic trade for 5, 6, 7 to 1 at least. So this really is our pick of the charts this week. So Swiss yen short, that's literally about to activate now for us. But like I said, these are our trades. This is purely for educational purpose, and you know, any trades that you are taking, please make sure you have done all your research and you are correctly risk managing. This is purely educational purposes, but I do like people to see what we are doing and why we are doing it. Right, okay, I think that's enough for Money Mondays. If you do have any charts that you would like us to cover in this week's content, please drop a comment in the chat box below. If you've liked the content, please remember to hit like, share and subscribe, just so all the videos come directly to your inbox and you don't have to search for whenever we put any new content out there. Some really exciting news coming into 2021. Registration has started right now. We are launching a new competition, and you know, this is probably the one of the main questions we get asked, which is, if we're good at trading, why do we charge to educate? So we're spinning it on its head this year. We're going to give away our education for 90 days, and the only thing you need to do is register by emailing mark@tradeandtrain.com or sophie@tradeandtrain.com. We'll go through how to enter, what the process is, what the 90-day challenge is all about, and there's going to be some mega prizes for those that are the most disciplined and that perform the best over the 90 days. All you need to do is have a live trading account, attend our weekly sessions, and follow our rules. So we're going to give you strategies, we're going to give you a checklist, we're going to give you setup tools. It is literally going to help you get your trading off on the right foot, you know, with no cost. You know, if you are out there right now trading and you're literally trading live with no education, just trying to learn from YouTube videos, that's great, but how about some support along the way and get to see those weekly leaderboards to see where you are in the see where you are in the charts, and if you are in the top 5 heading for some big prizes. Alright guys, well listen, we look forward to seeing you in the next content, and we will see you at some point tomorrow. Trade safely. Bye bye.